What is the biggest mistake that crypto investors do? What's that thing that you often neglect, you often don't think about, and that at the end of the day, it can really get you wrecked by investing in a certain cryptocurrency or token. This video will explain you exactly what it is, because sometimes it just feels like everything is right. The project seems to have a great team, great potential, even the technicals look good, and there is actually a lot of community within the project and a lot of people to drive up the price, but for some reason it doesn't go the way you expected. Well, we'll explain you what is this mistake and how you can avoid it in this video. As you can imagine, there are all kinds of crypto investors, and there are very different reasons why people end up buying tokens. You have, for example, some people, maybe like myself, especially in the beginning, that we are very worried about the fundamentals, about the vision we have for the project in the long run. That's very important to us, because we want to invest in projects where we see real potential, projects that have a great use case, can have a great impact in the world, or can really have some competitive advantage when compared to the market. I don't know, for example, looking at the Cardano ecosystem, probably projects like World Mobile that are doing something really important, connecting millions of people that have no reliable access to internet. Or for example, Book.io, that are solving a huge problem and creating a completely new product using Web3 and creating these Web3 books that you actually have ownership, that will be in the blockchain forever, will never be lost, burned or destroyed or whatever. So it's a real interesting use case, while also aligning incentives for the publishers and authors to be able to make more from their books. But of course, fundamentals are good, but they are not enough. That's the reality. And I've learned that across the years, that there are more important things. And even though when you're investing in fundamentals, you also don't like to spend the first years of the project losing. Then there are other kinds of investors that just do some technical analysis and buy projects based on the technical analysis. And that often works if people are good at what they're doing, if they're good at technical analysis. But at the end of the day, the technical analysis might be going wrong because of this factor people often neglect. And then there's the final factor, that is just hype. And it's very common to see a project going up, seeing the community showing all the earnings, everything they made from investing in the project, all kinds of bullish news being shared about the project. And as a normal human, you start getting the FOMO, the fear of missing out, and you want to invest to get some of those gains, because contrary to what you believe, it's always going up. It almost starts feeling like it won't go down, but the reality is that it will. At some point it will, and if you invest based on hype, the reality is most of the times you'll be left holding the bags for the ones that are making all those profits. So be very careful with that and pay attention to the project in itself, and try to invest in a better moment. All these investment types, all these ways of investing, they all can go wrong because of the same thing, that we don't give as much importance as we should. And the thing I'm talking about are tokenomics, the tokenomics of this project. And I know it's not something that seems that important. It can be a bit technical, especially if you're coming here new to crypto. But at the end of the day, you're not buying equity. You're not buying the actual project. And the success of the project doesn't mean that the token will succeed. That will depend on the tokenomics of the project. Okay, and that's why it is so important to dive deep into this and to understand really well the tokenomics, both for the short run and the long run, because it can have a lot of effect no matter for what kind of time length you're holding. You need to understand what is the tokenomics for the time length and what you should expect to be the influence of the tokenomics on the price. I'm not gonna lie to you, tokenomics is not everything. Sometimes there is hype, sometimes there are a lot of things that happen that reflect the move of a token in price, but the tokenomics will say a lot, especially in the long run. They will usually come to roast you at some point, what means that they will usually show themselves at some point, okay? And when you have tokens with huge supply, when you have all kinds of bad things, like for example, what it happens to meme coins, their appreciation in terms of price is also because a lot of times the tokens don't have that much liquidity. So liquidity is also very important in how price is calculated, because if you have a certain amount of the token there in a DAX, and if you have certain orders for a low amount of liquidity, then the price will increase because there's a low supply of the token. So your orders, your demand will increase the price, and that is how price can go very high exponentially, because even if it has a lot of horrible tokenomics, if there is no one available to sell that token, then the price will move pretty fast as long as you get someone to buy in. So what we need to retrieve from this is that sometimes the token doesn't reflect the success of the project, doesn't reflect the value that the project is capturing. And that happens, for example, in DAXs, where you can see that the tokens are given out as incentives, and the protocols, you know, they do a lot of money, they have a lot of fees, as you can see here, but that's not reflected in the price of the token, and the users don't really feel that appreciation. And most of the demand comes from the fact that people believe in the project and think it will do well, but there's also a lot of sell pressure. Okay, and picking up on that, let's dive deeper into the things that I believe are very important for you to consider when looking at the tokenomics of a project. Usually the tokenomics information is in the white paper or in a part of the website related with the token itself. Okay, I will show you here a few examples. For example, we here with book.io, you can find it like this, like you're seeing in the screen, where they have just a part for the token, but other projects and even book.io themselves, you can find it in the white paper. You just need to open the white paper. You can search for tokenomics and you can find the tokenomics, as you can see here, and that will give you important information. Sometimes it's true that you don't have everything, but to be honest with you, the safer projects to invest is the ones that have the most information, because it will allow you to make more informed decisions. So having more information about tokenomics should be important for you to decide whether or not to invest in a project. But when looking at tokenomics, it's important to first look at the supply of the token, how many tokens will ever be in circulation, to understand their potential, to understand through the market cap how many people are holding the token, how much you should expect the token to be valued in a certain period of time, a period of time that goes along with the period you're thinking about investing in. So if you're thinking for 10 years from now, then you probably will be able to have a larger market cap than if you're thinking like 6 months from now, right? So that's important to do some math and see what kind of prices you should expect. Another thing I think it's important is to see the inflation rate of the token. So to just take a look at, what's the supply increasing every year? Is it a token with a fixed supply, or there will be constant inflation? Just look at those dynamics and think of the effect they would have in the token. Because, for example, if a token has a 10% supply growth every year, it means it needs to grow the demand by 10% as well for the price to remain stable. So that's something very important to consider. Another very important thing is the supply and demand drivers. You need to look at the project, at the token, and think, what is the token going to be used for? What are the demand drivers? Why should people want to buy this token? Do they need it to use the protocol? Do they earn any kind of incentive? Where does this incentive come from? What are the reasons to have this token? Is just speculation, or are there actual benefits and actual demand drivers besides speculation that makes certainly a strong token stronger and more resilient if it has some utility? And then you need to compare them against the supply drivers. So basically, we will be selling the tokens. For example, if you're giving out tokens as people in a DEX, providing liquidity, then what happens is that these people that get the token have an incentive to sell it right away and make money for the liquidity they are providing. So that's a huge supply driver. But of course, there are other things like the team selling, investors selling, and everything like that. And picking up on that, that's also another very important thing you should look at. That is the distribution of the token. How is the token going to be divided? Who is going to earn what of the token? How much percentage is going to the team? How much percentage is going to the community? That's really, really important, I would say. For supply drivers, it's also very important for you to check how does the success of the protocol will be reflected in the token. For example, if the protocol is making some money in fees, how will that reflect into the token? Will that benefit the users? Does that matter? Or is the success of the token completely outside of the success of the protocol and there is yet no clear use case? Even in situations like that, you can take the risk and bet on that token, thinking that the team will create a use case for it in the future. But that's a risky approach, as you can imagine. Fair distribution of the token will tell you a lot, because if the token is not fairly distributed, the team can more easily sell the token. They can do a lot of sell pressure, and you'll have a lot of supply coming in. If you have advisors as well selling the token, that's really important to know how the token will be distributed and what kind of incentives do the people have. They have incentives to hold it or to sell it. Many times people from crypto projects will have to sell their tokens to fund the project and fund the development. So that's definitely something you need to consider. And that's the really important thing, is to check, if the game theory is right, if the incentives are aligned. It's just to check what each people is incentivized to do, each stakeholder, each person holding the token, because that will make you understand if it's more likely that the token will be heavily sold by everyone and the price will decrease, or it's more likely that the token will be held because it has utility, people need it, and then it's likely the price will be much steadier, I would say. Contrary to what we believe, there is also this interesting article here that showed something very different. It showed us that the prices, the tokens that are more centralized, that are less distributed and more controlled by a minority of VCs or big whales, have the most potential to actually rally. So that's something very important to consider. But of course, at the same time, you have more risk, because imagine one of these whales actually wants to sell everything and wants to give up on the project. Then the sell pressure will be huge and they can actually dump significantly on you. So it's like a short-term earning, let's say, to have less distribution, but it can be really risky in the long run, because it's only an earning until the token is going up. Because at some point, if one of those big whales and big price manipulators, we could say, give up on the token, then you can have a real issue. I think it's important to note that nothing in this video is financial advice, of course. I'm just sharing with you what is my strategy. And if that is being useful, please leave a like. Please also subscribe to this channel. We're trying to reach the 300 subscribers mark, so that will be really important. So I would say these are the most important things to look at. But another very important thing to look at, especially in the beginning when a project is early stage, is the vesting schedules. As you know, or you might know, or as you'll learn now, the team, the investors, early investors, VCs, they have a vesting schedule where they get part of the tokens as time goes by. And when we reach certain milestones, certain deadlines, they get unlocked part of their tokens. There's tokens that, are either tokens from the team, so tokens at a much cheaper price than the one you're buying usually, or tokens from VCs that were able to enter in the project early, in the earlier funding round at a discounted price. And as you can imagine, those people usually are in profit or might even need to sell something to fund new investments or to fund even investments in the project when we are talking about team. So it is important to notice that they are usually very prone to selling their tokens whenever there is a token unlock, even if they don't sell everything, I would say. As you can see here for these examples that are going through the screen, in these days we had token unlocks, and then we see projects going down. There is a good website to take a look of that is Token Unlocks, but as you can imagine, they don't have the information for every project. So for example, for Cardano and for some projects in the Cardano ecosystem, the best thing you have to do is to go yourself to their white papers of the projects you're investing in or thinking about investing, and check it by yourself so that you're sure that you won't be caught up in a token unlock, because it can happen that you buy the project, you buy the tokens, and then there's a big unlock, and then the price goes heavily down. You'll be holding the bags and you'll be in a significant loss. So that's very important to consider, as it can even warn you about which times are good to invest, which times you should sell the token, because it might make sense to sell it in advance and to be able to buy it for a cheaper price whenever they dump the token. So that's really important for you to guide your investment. So yes, this is what you should do. You should always take a look at the tokenomics, no matter what is the reason you're investing. Even if you're doing some investment based on technical indicators, those are good, those can work. But imagine you're investing into a project, you have these technical indicators, and then it goes completely wrong. What are you going to do? You're just going to sell at a loss? That's an option. But if you had a token, if you're investing in a token that you actually think has long-term potential, and you check the tokenomics and it adds up, even if you had that problem, you know that if you hold it for long enough, you'll be able to probably make much more. So that's also something to consider. And something that's even important for you to avoid holding the bag if something goes awfully wrong. But of course, you can just work with stop losses and don't care about that at all. But it will depend in what level of technical trader you actually are. But for everyone investing, I think tokenomics is very important. It's very important not to be caught off guard and not to be dumped on, and even sometimes can be very useful if you know the vesting schedules, if you know the supply dynamics and everything, to pick up the best times to invest in these projects. So that's also something very important to consider, I would say. So again, please, whenever thinking about investing into a project, take a look at the tokenomics, look at the supply and demand drivers, look at the distribution, look at the vesting schedules, token inflation, of course, the whole supply of the token as well, and the market cap you should expect for the token, and even the incentives each of the stakeholders have with the token, what kind of utilities it actually has. Those are the important things. You have this video to guide you, you have these topics here to follow. I've shown you here some examples of how you can see and go through the tokenomics and the kind of things you should expect to see for each point. But of course, I'll also show you here in the end video a great example of what I think is a real good tokenomics. In fact, is the tokenomics of VI Finance. We did a video diving deeper into it, because even though they are in DEX and they have a huge supply issue thanks to the problem of giving the token as an incentive to the community, the truth is for VI Finance, the token is very well distributed, and they have demand mechanisms that are very interesting, like for example the Wi-Fi bar, where basically people can benefit and earn from the fees of the protocol if they stake their tokens, and by staking their tokens they will actually not be selling them. They also have other interesting things like governance, etc., and other reasons to keep and to hold your tokens, and I think it's a very interesting tokenomics and an example to many DEX. So definitely something you should watch if you want to dive deeper into tokenomics and just upgrade your skills in terms of this analysis. And on my side, thank you so much for watching, thank you so much for listening, and I'll see you in the video about VI Finance.